Dividend investing gets a fair bit of hate. It seems that either you back it 100% or you just think it's a big waste of time. I get a lot of comments on this channel telling me that dividend stocks are rubbish and that I shouldn't be investing in them, especially when I'm young and decades off retirement. I've definitely gone on my own roller coaster of thoughts, emotions and feelings when it comes to dividend investing, and I wanted to address why I choose to invest in dividend paying stocks, but also talk about some of the common arguments for and against this style of investing. I started investing in January 2020 when I bought shares in the FTSE 100, an index tracking the top 100 companies in the UK. I then continued to buy different ETFs and index funds right up until this financial tax year, when I started to purchase some dividend paying stocks, whilst also investing into VUSA, which, if you didn't know, is an S&P 500 index fund. I developed a real interest in investing and I wanted to learn everything. So naturally, I came across different investing strategies that people use. Everything from passive to active to value and index investing. It almost started to feel that I needed to make a choice and park myself in one of these groups and not deviate from it. I began to learn about dividend investing, specifically dividend growth investing. And I grew interested, but I knew I also wanted to keep putting my hard-earned money into index funds and ETFs. Could I do both? The idea of dividend investing is to invest into companies that will pay you in the form of a dividend just for investing in them. One big problem with it though is that companies can just cut their dividend without any warning or say from the investor. To combat this, some investors choose to invest into companies that have a track record of paying reliable and growing dividends year on year. And this is called dividend growth investing. This provides dividend stability, and some people enjoy knowing that whilst a share price is fluctuating, their dividend income is relatively stable. Checking whether a company has a good track record of paying their dividends and increasing them dividends year on year is definitely something that I looked at when deciding which companies to actually have in my dividend portfolio. And I'll continue to look at this if I decide to add any more companies to my portfolio in the future, because being able to sustain and grow dividends year on year is typically a good sign that a company is growing its bottom line and generating solid cash flows. However, I don't do this perfectly. I do hold some companies whose dividends have increased, but they've not gone up every single year. Take Unilever. I've recently added this incredibly popular stock to my own portfolio. Watch this video that I'll link up here if you want to find out exactly why I did that. But technically, they haven't been seen to increase their dividends year on year every single year for a long time period. If you look at their dividends, they did increase them between 2006 and 2010. But then they dropped, and a similar thing happened in 2021 after they increased them for many consecutive years prior. Whereas if you look at Diageo, they've been upping their dividends every single year since 2006. Of course, even investing in dividend kings and dividend aristocrats provides some stability, but it's not a guarantee. However, I guess nothing really is. So why do I have a dividend portfolio that I'm growing at age 26? A lot of long-term investing comes down to the psychology of it and staying committed and motivated through many decades and during different market environments. Dividends are tangible, and seeing them grow and come through is really satisfying and helps you stay motivated to carry on. Stock markets go up, but as we know, they also go down. And it can sometimes, for some people, be really hard to pour your hard-earned money into something when you see it going down. Some may love this and see it as a right bargain, but for others it's really hard. Capital gains or losses depend on what the market is doing, which as an investor you can't really control. But dividends do not depend on the market behaviour. They depend on how the company in question is actually performing, and as long as the company's fundamentals are good, then more often than not, they will continue to pay their dividends, regardless of market conditions. And this provides stability and motivation. My goal with my dividend portfolio is to create an increasing stream of income over time. I want it to grow over years, where it gets to the point that I can use that money to pay for rent, mortgage, bills, whatever. It would be amazing to get this to the point one day where I can match my monthly income from work. That really would give me financial freedom. And I think it's really nice that you can actually track your dividends and watch them go up over time. For some people, being paid dividends just doesn't matter, which is really fair enough because there's a lot of solid arguments against this style of investing, which we'll get onto later. But I think if an investor is able to better control their emotions and remain disciplined, then it's got to be a positive. Another important thing for me is that I don't want to just invest invest into companies that have a high dividend yield, because often this would mean investing in not very good companies or companies that just have a high dividend yield in order to draw investors in, but they're not actually growing and don't have good fundamentals. And one risk with this is that you get sucked into high dividend stocks who then just cut their dividends. There is a worry of being limited as a dividend investor. The idea that if you pick to invest in dividend stocks, you're going to be limited to how much market exposure you can get. This is a very valid point, because let's say you invest in 30 different dividend paying stocks. Well, that's great, but you're still not going to get as much market exposure and diversification as you would if you invest into a broad market index fund or ETF. This was definitely a concern of mine, but you can get dividend paying ETFs. And just for me personally, I decide to continue to invest in VUSA, and I also still have exposure in the FTSE Global All Cap. Another concern people have is that dividends are taxed. Well, if you hold your investments in a tax efficient account like an ISA or the equivalent, then your dividends aren't taxed. If you hold these stocks outside of an ISA, then you do pay tax, but you do get a dividend allowance every single year, and the amount that you pay outside of that depends on your income tax band. Another reason why people hate on dividends is because dividend stocks underperform compared to the market. This is such a fair point, but it does really depend on what two stocks or what two portfolios you're comparing. You can actually find lots of studies looking at historical data showing you how dividend growth investing actually outperforms the market, like this one. But you can also find lots of historical data showing you how index funds will do better. It will depend on the market too. Is it a bull market? Is it a bear market? And also the industries that dividend paying companies represent. For example, currently, energy companies will be doing great. Shell and SSE have outperformed the FTSE 100 year to date. And this isn't surprising given the situation. Energy stocks tend to be dividend payers, and those are the ones that have been having a much better time recently than just the general UK market. But if you look back a couple of years to COVID, you'd probably see that Unilever was doing really well. With its non-cyclical nature and being able to produce things that people really need, it was probably outperforming non-dividend paying stocks or just the broader market in general. The last thing that I want to point out is that dividends are a really big factor in total returns. Total return is the capital appreciation in the stock plus the dividend, meaning the dividend is part of that total return. From 1930 to 2017, dividends accounted for 42% of the S&P 500's total return. And this just highlights that they are an important factor. This table shows what percentage of total return dividends make up throughout different decades. And you can see that sometimes it's very high. An argument for dividend growth investing is that if you own a non-dividend paying stock like a growth stock, then you only benefit from price appreciation. The share price of a stock could increase over a long period of time, but if it then decreased just before you needed to start selling for retirement or for whatever reason, then you could miss out on lots of years of those capital gains that you've earned, and also you could miss out on loads of unrealized profits very fast. But if you had a dividend growth stock, you'd still have the increase in income from the dividends. Ideally, you'd want to find those companies that are not only growing their dividends, but also their net income and revenue too. I do, however, see the other side of this, and I'm a massive supporter of index funds and ETFs as well. I'm sure there's so much more to be said on this topic, but I'll leave it here. If you want more videos about dividend investing, then just let me know.